Good morning. I'm Daryl Jones, Director of Research at Hedgeye Risk Management. I'm joined by my colleague Hisham Shaban, who runs Internet and Media Research. We're here to talk today about a stock that we were the original bears on Twitter. Twitter reported last night. Metrics were pretty soft. Stock's down about 20% this morning. And what we think this report does is validate a bunch of holes in the business model that Hisham is going to update us on.
Yeah, so when we talk about holes in the business model, what we mean is headwinds to each one of their growth drivers, being reach, engagement, and monetization. With this earnings release, what we saw weakness in both reach, being user growth, and engagement, being timeline views per user.
Okay. So
in terms of reach, user growth in the U.S. slowed on a year-over-year basis to 20% year-over-year growth versus 33% in the quarter prior. And on a quarter-over-quarter basis, they only picked up 1 million users.
Gotcha.
So the reason why we see headwinds to user growth is really because we think Twitter is more penetrated in the U.S. than a lot of people suspect.
So on the monetization point, that's one thing that you were more positive on. But what do you see going forward on ARPU or monetization?
In terms of monetization, this quarter was actually a pretty strong quarter for Twitter. I mean, monetization improved in terms of ad revenue per 1,000 timeline views. It grew 76% year over year versus 49% in the prior quarter. Now that's great, but when we think about moving forward, towards the back half of 2014 and into 2015, there's only so much runway for that to improve, because a lot of that has really come from what we call the mobile migration. And that is both the migration of Twitter's users onto the mobile platform, where they're more likely to engage in products, and Twitter moving its ad products over to mobile at the same time. Eventually that tailwind from moving everything over to the mobile side
becomes a headwind.
It becomes a really tough comp.
So now, kind of looking forward, stock obviously once again down a lot this morning. What's the next catalyst? Are consensus expectations too high? We know it's a lofty valued stock. So what do they have to do to get the stock, I guess, going up again?
Yeah, that's a tough question. I mean, right now, consensus estimates were pretty lofty to begin with, and we're going to be monitoring that very closely to see where they trend right now. But I mean, for consensus to assume that this stock is going to grow, plus 50% in perpetuity through 2016 is pretty foolish, in our opinion.
Makes sense. So once again, I'm Daryl Jones, Director of Research at Hedgeye. This is my colleague Hisham Shaban, who runs Internet and Media Research. We're the original bears on Twitter. We remain bearish. If you have any questions, feel free to tweet us at Hedgeye. Thank you.